The Taiwanese index is up 0.5%.
I think we can avert a recession if there isn't a policy mistake, and that's very important because that matters a lot for earnings.
Food inflation was 4.19 in December. It is 5.94.
That's the first take on the index. The sensex and the nifty up about 0.3%.
At the moment, we're keeping it again very tight because there's a lot of there's still the data volatility which is keeping markets the way they are.
The benchmark indices are holding up in the green. It's up 70 points on the Nifty.
We do have the January WPI data, which is coming at around 4.73%. This compares to 4.95% on a month-on-month basis.
Well, we're still very bullish on India. As you know, I've been a fan of India for quite a long time, but that excitement that I have about India is actually increased.
To me, windfall tax is something like revenue generation for government.
Markets are picking up. It's more than 17,900.
Well, that was a day so far. You're with us here on a fresh new edition of Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi here in the studio. And Nigel, of course, joins us from the newsroom floor. Guys, hi, good afternoon. Full house and good to see all the faces. I mean, we've got, 160, 165 points. These are strong gains from the word go on the Nifty. But it looks like, almost two markets, right? The Nifty is doing well. We are above the 20-day moving average. It's been comfortably above that for the last many hours. And I mean, just to get the Nifty level out, a solid close above the 17,960, which is, almost where we are, another 35 odd points, and you cross that 17,960 level, I think it would be a bullish kind of outcome. What is 17,960? It's a rising channel. It's a very short-term channel. From the highs of the 3rd of February, post-budget high, there's a touch point of the 8th, and of course there's a touch point later today as well. I mean, we're actually trading in the high point. We were above it, and I think we are now under it. So a solid close above that 17,960, I think, would be a bullish outcome, which many would be hoping for. But as I said, the mood is somber, right? I mean, it's almost two halves. The Nifty is doing what it is, but broader markets are not. A 0.25% cut respectively on the mid and small cap indices. Market breadth is still negative, not as negative as it was in the first 2 hours of trade, but it is still not doing all that great. And I think the big data point, which may have an influence in terms of gains being tempered over the next even 60 minutes, is the US CPI number, which is of course later in the evening out of the US. And I think that's got the potential to kind of swing things either ways. If you go by brokers like JP Morgan, Morgan Stanley, etc., I mean, a beat or a miss could potentially be worth 2.5% of the S&P, either up or down. So I think it could be a big one when we come back tomorrow. So that's, of course, later, post-close and around US market time. Reema, hi. Surabhi, hi.
Hi. So India time, it's about 7 p.m. So that's when we should expect the US CPI inflation print. But around that 17,960, the important level that you were tracking, you also have the 100-day moving average, which is 17,000, sorry, let me just get that number up, 17,945. So that's the 100-day moving average. And the budget high was 17,972. So this entire zone is going to be a bit of a congestion zone. And let's see whether we can surpass it. The high today was 17,954. So we've not quite gotten to that levels of 17,960 or the budget day high. We've fallen shy of that, but there is a lot of momentum that you are seeing in the market. Remember, the Nifty has not gone to levels of 18,000 plus since the 25th of January. One of the big contributors on the way up has been Reliance Industries. Now, Reliance Industries has about a 10% weightage on the Nifty, and with the up move of 2.5% that you are seeing on Reliance Industries, it's contributing close to about 40 to 50 points. If you pull up that contribution plate, it's a 40-point gain that Reliance Industries single-handedly is contributing on the Nifty. And Reliance for the last 1 year has traded in a complete band. That 1-year chart will come up for you on Reliance Industries. It's been in a band. Whether it can break out, that remains to be seen. There you have it. It's again gone towards the lower end of the trading band in the last couple of trading sessions. And today you are seeing a bit of an up move. IT, FMCG firing for the bulls. So you've got names like ITC. It goes ex-dividend tomorrow by 6 rupees. So remember that. ITC is up nearly 6%. HCL Tech and Forces, showing you strength. ICICI Bank has made a decisive move higher in the last 30 minutes. But again, the pressure is in the broader markets. The mid-cap index still trading like yesterday.
Oh, absolutely. And that index actually has been underperforming the broader market right from the start of the year. We know that the Nifty is down by about 1% for the year as of now. The mid-cap index is down 3.5%. If you're looking at the Nifty micro cap, then that index is down 5%. So, that is a trend that's continuing. When it reverses, we will have to see. The consumer rally today is really something worth taking note of. IT, of course, banks, Reema's mentioned. But look at what's happening with a lot of the consumer stocks. And ITC is just bursting through the charts. It is the Nifty winner once again today. And then you have some more names. Britannia, there's Nestle coming out with numbers tomorrow, Tata Consumer. So the consumer is alive and kicking. At least that's what today's trade is telling you. So good going over there. And beyond that, I mean, even some of the other names in the broader markets on the consumption side are okay. There are the odd stocks like Nykaa, which we will talk about in a bit. But Nigel, I guess the bulls would just heave a sigh of relief that there is decisive green on the screen after many days today.
I don't know about you guys, you're talking about inflation print at around 7 p.m. Guys, it's Valentine's Day. I thought you would be hitting it out of the park, maybe sipping on some wine, listening to some good music or something like that. But we'll take
Nigel, that tells you so much, right? Like about 2-3 years back, you and me would be joking about, Valentine's Day. Today we are talking about Nifty levels, inflation. It's a sign of times.
Yeah, no, but Valentine's Day, make sure it's special, guys. Anyways, let's get to the celebration today. The bulls, they are celebrating Valentine's Day in style. Just take a look at that. It's been that sort of a trend day, and I've seen this day after a while. So for starters, the Nifty IT index that we pointed out earlier today, Nasdaq had a bit of a relief rally, so the IT index would do well. But what's helped our cause is midway through the trading session, the Nifty Bank as well started participating. And just pull up the Nifty and the Nifty Bank and the levels that we're looking at. The 20 DMA, well, that's been conquered. Now you'll want to end closer to around the 100 DMA, or maybe in fact end above these technical levels. That will set us up perfectly for tomorrow in case you get an inline inflation number or maybe a little softer than expected. And just take a look at it. Going into the event, there's a lot of put writing that we have seen. 17,800 put, 17,900 put, and 17,850 put. Just take a look at that. More than 50-60 lakh shares have been added between the three of them, telling you that, in the near term, maybe in fact that 17,700 odd mark could hold out. And if that's the case, then it's giving you a sense that maybe we're going to give it a bit of a dash towards 18,100. That obviously depends on this evening's inflation print. But last few days, we've been going to around 17,700 to around 17,770 odd. And we have bounced at those levels. So it's setting us up perfectly. But final 60 minutes, guys, let's take it ahead.
So let's tell our viewers what's lined up in the final 60 minutes. Eicher Motors reports an inline set of Q3 numbers, but there is no positive surprise, so the street is disappointed. The stock is down 3.5%.
And from the auto ancillary space, Bharat Forge also posted a good set of numbers for the third quarter. Revenue growth came in at 22%. But the stock is currently under pressure. Baba Kalyani, the chairman and MD of Bharat Forge, will be joining in to talk about the company's performance.
We'll track market technicals with Jay Bala of cashthechaos.com.
And later on the show, we will have stock talk and portfolio bets with our alpha manager of the day, Shibani Sarkar Kurian of Kotak Mahindra AMC.
Okay, that's the lineup. Let's tell you how to position yourself in the last hour. Mitesh Thakkar is with us of earningswaves.com. Mitesh, good to have you with us here. What do you make of the up move? It's solid. It'll hold any threats later from CPI and things like that, or you think it could fade away? What's your sense?
News is always a risk, but I think purely going on the indicator setup, I think finally we are heading towards that upside break of 17,950 zone. I think the next target is around 18,030, 40, and then 18,150, which was the pivot made in the mid month of January. So I think again trading with mild positive bias. In fact, we have increased our long positions in the last few hours. So my sense, the initial feeling is that, and while as I said, I think news is always a risk, is that the markets might actually, if not gallop on the upside, at least will take a shift on the upside, and the range could possibly now be between about 17,800 to about 18,150. So in that sense, trading clearly on long side. I have a buy on Reliance, and that's one of the reasons I'm also positive on the market. After a good correction, Reliance is finally showing signs of turning on the upside. That's a buy with a stop below 23.55. And look for a target of around 24.20, 24.25 on the upside to begin with. and then a buy on Shree Cement with a stop below 24,200 levels for targets of around 25,350.
Mitesh, thank you very much for that. Bharat Forge is on our radar. Reported their Q3 numbers. The stock initially sold off, was down 3%. Since then, it's recovered a bit, but still down 1.8%. The street is disappointed on three accounts. One, the domestic revenue growth was muted. It declined 1.7% on a quarter-on-quarter basis, but year-on-year, it was only up 5%. Two, the overseas subsidiary clocked in an EBITDA loss. And three, the debt too has seen an increase. Baba Kalyani, the chairman and managing director at Bharat Forge, now is with us on the phone line. Afternoon, and thanks so much for joining in. Could you talk about the domestic revenue growth, sir? 1.7% down quarter on quarter. Year on year, it slowed down to a mid-single digit growth rate of 5%. What is the outlook and what's pressuring the domestic revenues?
Well, as far as the domestic revenue, we are pretty much on track with the industry revenue. Industry revenue has been, almost flat or little low. So that's what is reflected in our domestic revenue. I think going forward, we should see a fairly good increase in our domestic revenue. That's our projections.
Mr. Kalyani, could you elaborate on that when you're saying you're expecting good growth on the domestic business? Some more color on what the driving factors are going to be as we enter the next financial year. Which segments would you keep your sort of most keen eye on?
Two or three segments. Number one, I think we are doing well on the pass car related businesses domestically, as well as, of course, for exports. So we see growth in that area. We are also seeing a lot of new business in construction equipment, mining equipment, and all the industrial related products. So we see growth happening there. We have recently acquired a casting company called JS Auto, and that is growing at a very fast pace. So we see growth coming there. So we have multiple levers of growth in the domestic market that will help us our domestic revenue.
All right. Hi, Mr. Kalyani. Good afternoon. Nigel on this side, sir. What about the export markets? How are things shaping up out there? And also your overseas operations, they posted an EBITDA loss this time around in your overseas subsidiaries. Do you expect it to turn around in the coming quarters?
First, let me answer your first question. I think on exports, we have had the highest ever export revenue for the quarter at 1,166 crores. And we are quite bullish on the exports even going forward. As far as our overseas subsidiaries are concerned, I had said that last time also that we will take 2 quarters to come out of our issues of ramping up production. All the new orders that we have got, our order books are full in the aluminum business. We are also facing a lot of issues regarding cost inflation, and we have to recover some of these costs from our customers, so that process is going on. But we are very confident that we have a path to profitability for this business in FY24.
So, sir, 2 quarters of overseas EBITDA loss. So Q4 will also see a loss? And will it be higher or lower than what we've seen in Q3?
Much lower.
Okay. And what will be the reason for the EBITDA loss to come down significantly quarter on quarter?
As capacity utilization will go up, number one.
Okay.
Number two, our compensation from our customers for all the energy increases, inflation increases will come in.
Mr. Kalyani, what on the defense side of the business as well? I believe your defense order book stands at just about 1,950 crores. So typically, what's the execution time cycles? As in when does all of this start getting booked in over? Is it Q3, Q4 of next year? And again, just to get back to the top line growth, the domestic business top line growth, with defense kicking in, would you perhaps get back into double-digit growth territory in FY24?
Yeah, that's for sure. We will have if you put defense into it and our JS Auto casting business into it, we'll definitely have a pretty high double-digit growth going into FY24. number one. Number two, our total defense orders are currently over 2,000 crores. These are all exports, by the way. We are also expecting substantial domestic orders to come in the next few months. But our the execution of these orders will be roughly about 1,100 crores in FY24 and increasing in FY25 and going forward.
Okay, all right. Mr. Kalani, what about the leverage in the books? You know, debt continues to remain elevated around 2,500 crores. Or do you have any plans of pulling this debt down, maybe a debt reduction strategy?
It's a little bit of an optical problem because the debt that you're seeing in the book is largely the bill discounting debt. We have, in terms of long-term debt, we have 3,000 crores of cash in our books right now. So our long-term debt is much, much lower than the cash that we have. As far as the working capital bill discounting, that is self-liquidating debt. So, you know, we're not too concerned about that. As our exports go up, our export, you know, pipeline in terms of the total time it takes for cash conversion cycle is a little higher than domestic, and that's why you are seeing a higher number there.
Mr. Kalani, hi. Just one last question. Just last week we got the US Class 8 truck order data, and that shows actually a very steep fall. For the month of January, that number is 21,600. It is down 24% month on month, and of course, I mean, from the highs of September, it is a far cry, less than half. Could you tell us how this will impact business?
Well, you know, first of all, I don't think this has any impact in terms of what happens in production because everybody's order books are more than 1 year full packed. So the impression we have from our customers in US and Europe is that they see a very strong delivery of Class 8 vehicles in 23 and 24. So, and we are seeing the same at our end, and that's how our exports, even in that sector, are increasing quite rapidly.
All right, Mr. Kalani, we'll leave it there. Good to speak with you as always after results, and hope we can catch up again soon. Thanks very much for your time here on CNBC-TV18. Let's stick with the auto space, though. Eicher is the other one which is actually in focus. They reported numbers just a while back. Sonia is here with a quick take in terms of earnings fine print. Sonia, over to you.
So thanks a lot for that. If you look through the numbers, carefully, you'll notice that the margins are under pressure for 2 consecutive quarters now. In fact, the margins at 23% are below the estimates of 23.8%, and it's a 30 basis points quarter-on-quarter fall that we've seen in margins. Now, if you pull up a trend of the last 4 or 5 quarters, you'll notice that, over the last 3 quarters, the margins have fallen from 24.5% to 23%, and that's perhaps because of the higher sales of its low margin Hunter 350cc. Now, the Hunter 350cc, which was recently launched, is a product that's doing very well, but it's dragging the blended margins lower, and that's something that has worried the street for a bit, and hence the stock could be under pressure. Otherwise, if you look at it, no real problem on the top line. The revenue growth of around 30% coming in at 3,720 crores. The core EBITDA as well has gone up about 47.2%, but it is this blended margin drag because of the new product, which is something that is spooking the street. Back to you.
Okay, all right. Thanks a lot for that, Sonia. By the way, we have Grasson's numbers that are flashing for you on the screen. And in terms of the consolidated numbers or the share price, bulk of it comes in from its holding in Ultratech Cement. But we're looking at the standalone business, and just 2 numbers is what you should track. It appears as an operational miss because the VSF business, the EBITDA number is coming at around 63 crores. I'm looking at Kotak's estimates. Well, they were working with a number of close to 130 crores on. So the VSF business on the EBITDA front, it was expected to decline, but it's declined more than expected. So that's point number 1. The second factor is the chemicals business, which was expected to contribute bulk of the profitability of the EBITDA. Well, that, Kotak had put out a number of around 580 crores. It's coming at around 490 crores odd. So there's a miss on both their verticals. VSF as well as chemicals business. That's why the standalone business goes down as a bit of a miss. We'll be waiting for any kind of clarity in terms of what's the outlook on paints, when do they launch this division, and how are things shaping up as well. So we'll get to that in just a bit. Mehrabun Irani joins us on the show. Hi Mehrabun, good afternoon. Well, any view on some of these frontline stocks, whether it's Grasim, the numbers have just come in, but a broader outlook in terms of Grasim, how do you approach the stock? And the other one is Eicher Motors that Sonia just spoke about. They've launched the Hunter. It's doing good for their volumes, but margins are coming under pressure.
Well, Grasim, I would like to give it a pass, honestly. But Eicher Motors, let me say something that while the margins are under pressure, we very well know that numbers on the surface looks quite good. I think margin pressure, if that is a concern to the market, it's bound to happen. You have had an excellent response for the newly launched Hunter 350. The higher sales for the Metro version as compared to the Retro version. Now, if you believe in this, that's the value engineering, the pricing initiative, the pricing action, and the flexibility to ramp up production ultimately to 100% as far as the Metro version goes. I think if that should improve margins, my answer would be yes. That certainly happens. So it takes its own time to happen. So if that is the reason why the margins have come down or why the street is disappointed, I personally believe that if one believes in this value engineering and the pricing action where this company is bound to take for the Metro version, I think margins should improve going ahead. Also, the stock has reacted quite well from its recent peak of by 20-25%. So I would say at this present price, I would not be too hesitant to possibly say that Eicher could be bought into. That's my personal feeling. At 3,000, 3,100, I think it's a decent buy. Also, we need to understand CV sector is on a growth path. Also, the MCHV and the buses segment certainly is much below its peak of 2018-19, but the recovery normally takes 4 to 5 years for a new peak to come. So if all that things are understood well by the market, I think going ahead over the next 12 to 18 months, I think the numbers will be much different than what they are today on the positive side. So I would say at 3,100, if I was holding Eicher Motors, I would certainly not be selling in a hurry. In fact, I would look for the price to settle down maybe a little bit lower from here and possibly add to my holdings.
Mehrabun, afternoon. Any thoughts on Eicher Motors? We just had the management of Bharat Forge, Baba Kalyani, on the show, and he seemed to suggest that the overseas performance, the EBITDA losses in their overseas subsidiaries will come down in Q4, and in Q1 of FY24, that's 2 quarters, hence it will perhaps turn around. And they've incubated so many businesses, whether it's defense or it's on the electric vehicle side. He was bullish on the construction equipment space, the casting business, and it appears all these businesses are at an inflection point, and at some point it's going to start firing for Bharat Forge. Would you be a buyer in Bharat Forge, and your thoughts on the business and the way it's moving?
Well, I've tracked this company for many years, if you ask me, and I think more often than not I have been disappointed, to put it in a very blunt manner. But yes, the company has made good initiatives. It's come out of it's developed new frontiers for growth. It's gone beyond its core business over the years, and I think the investments which it has put, certainly in sectors like defense and EV, and like you rightly mentioned, and I agree with you, they are at an inflection point. But we need to understand we are in an environment in which this company depends quite a bit on the European Union and on the US, which both of them have their own macro concerns at the point. So while a guidance is a guidance, ultimately a promoter is going to speak that things should improve, and I'm not saying no. But I would say traction, if any, should be happening in this defense and EV business, and that is the way to look forward for this company and for us investors. But the valuation at which the stock is, I think 27 or 28 times FY24 earnings. Is it a screaming buy in this market environment? I would certainly not be in a hurry to recommend this stock. And as I mentioned earlier also, I think guidances are guidances. How much of that gets fructified and how soon it will get fructified is a different issue. The company will do what it can. And as I mentioned earlier, it has made initiatives in the right segment, and those segments are going to grow. But how soon it will happen and how much it will happen is a different call. The stock is certainly not cheap in terms of valuation. So if it shares maybe about 5-10% from here, possibly one can look at it a little bit more favorably than the level at which it is right now.
Okay, all right. On that note, we will take a break. By the way, some of the agriculture-related stocks or fertilizer stocks, you can call them that, are doing extremely well today. NFL, RCF, and of course UPL on the frontline space. Extremely strong moves in some of these names. Those are the fertilizer ones. UPL itself is up about 4.5%. We'll take a break and come back, actually discuss some of these stocks in this whole space with Mehraboon. And we will also get chatting with Jay Bala. He is going to join in and give us a technical view on the way the market is poised at this moment.
Welcome back. Let's continue our focus on earnings. A whole host of stocks are seeing big moves post their quarterly numbers. Vahishta has a roundup of those names. Vahishta.
Hi Rima, thanks for that. Well, let me start off with all cargo logistics, when the stock was actually trading quite in red in most part of the day, and this is primarily due to a weak set of Q3 numbers. The revenues were down 27%. The margins had come in at 5.6%. We also hosted the management on our channel today morning, and they had said that there's an expansion in their market share. The LCM business market share currently stands at about 15%, and the management is quite optimistic on seeing a trade volume pickup February onwards. Moving on to HBL Power Systems, when the revenues have come in at 332 crores, while the margins are at 11.4%. Also, the new development in the company is that HBL shall be investing up to 150 crores in Tonbo Imaging India. Also, the company will make a nominal investment in Tonbo Singapore, and this is to enlarge its presence in the defense electronics manufacturing. Now, moving on to the pharma space, Newland Laboratories, which has seen a steady growth this quarter. In fact, the margins have improved to 20.1%, which is led by a shift to higher margin products, and the debt equity ratio is at 0.13 times, which is due to a debt repayment of 80 crores in the past quarter. Back to you.
You got that, Vahishta. Thanks very much. Prashant, I was just thinking, managements are seldom pessimistic. Managements are always optimistic, right? I was just taking off from the first point.
Investors also. But you have to be, right? I mean, you have to be an optimist if you want to make money. I mean, and of course, not foolhardy, but optimistic. Generally, as a frame of mind, approach things with the view that things will work out, right? I think that's the. Just one thing, actually, in HBL Power's case, I think the rally started. The numbers, if you look at the third quarter, as Vahishta also pointed out, it's not anything incredible. But in the presentation, what HBL is saying is that their EBITDA will go up 3 times by 526. So in 3 years, EBITDA will be up 3 times. I think that is what the market was paying attention to. And in the case of all cargo, the stock is 10% off the lows. And I was talking to Nigel outside the studio, and I think they spoke, Nigel Mangalam spoke with the all cargo management. I think adjusted for a subsidiary, the numbers are still down, but they're not as down as what the headline figures look like. In the case of all cargo. So that is recovering, and I think the outlook also perhaps is not all that bad. I don't know if Mehraboon has any view, he tracks any of them, and any thoughts. Mehraboon, go on.
I think quite positive on the company, if you ask me. I think not very comfortable with the earnings, and since you mentioned what you are mentioning while I am on this show that the stock had reacted, I think I will possibly use this correction as a buying opportunity. Also, I will not be surprised if there is some sort of demerger or something which will happen in this company, and some value unlocking also can happen. So still, I feel the valuation is a little bit high, but as a company, decent regard for it. And I would say that the stock, while not a screaming buy despite the decent correction, but this correction definitely offers scope for investors who are looking at things from the longer term angle, because as far as business goes, I think business-wise, they should continue to do well. I'm referring to all cargo right now.
Got that, Mehraboon. Okay, and before we let you go, as I was pointing out earlier, this whole move in some of the fertilizer stocks and agriculture-related stocks like a UPL, any interest here? I mean, UPL, if you look at it on a longer time horizon, barring the trading ups and downs, it's been in a range for the last year and a half. Your thoughts before you leave us?
Well, I think as far as UPL goes, I always rated as one of the leading global agrochemicals company. I think the company in the past, maybe 10 years, 12 years ago, I think they had their own problems as far as the forex debt goes. I think they've come a long way. I think very aggressive management have done good things for the company. But in terms of deliverance over the last 2 or 3 quarters, what the company has gone on mentioning, they have failed to deliver. I think even in this quarter, I think one more quarter, if they don't achieve what they have been mentioning, I think the street would have reasons to feel disappointed. As far as the entire space goes, I think there are names like a Southern Petrochemicals, which is Speak, which has consistently come up with good numbers for the last 3 or 4 quarters. And I think in terms of valuations, I think it looks very attractive. I would possibly go with it right now. With clear disclosure, I'm personally holding that stock.
All right, Merabun, great chat as always. Thank you very much for joining us with that perspective. It's always a pleasure having you with us on the program. Jay Bala is with us now of cashthechaos.com. Tuesday afternoons, it's Jay Bala chat time. Jay, good to have you here. Good afternoon. How is the view evolving, Jay? I mean, you were cautious to pessimistic. I mean, if that's the scale, and I want to ask you, where are you on that scale now? Tilting towards pessimistic or, just cautious?
Yeah, good afternoon, Prashant. Thanks for having me on the show. Yeah, I'm still pessimistic on the market, but the markets are getting into a very complex correction. It's pretty obvious to me that it's not start of a new trend to the upside. So what I had, my view still continues along the same lines. But the market had to complete a move past 17,917. At least one tick was above that required for the market to complete a pattern. The market has done that. It's come to 17,954. I think a break below 17,652 would signal that the next leg of the down move has started. So we are waiting for the markets to play out in the next few days.
Okay, so you're retaining a negative call, Jay. Take that, 17,652, and then you're expecting another leg down. Okay, let me ask you, what's looking weakest in the market to you at this point in time? Is it the banks? Is it which set of stocks?
Yeah, that's right. It should be. The banks, the range is more compressed than that of the Nifty. The focus on the banks is negative, and SBI and ICICI the main contribution for this. And the resistance for the banking index is about 42,280. Once it goes below 39,170, I would expect an acceleration towards 37,000 and 35,000. So the price action for SBI and ICICI are saying that they are facing considerable amount of resistance.
All right. Hi, Jay. Good afternoon. Jay, this cautious view on the Nifty has worked so far. The last few weeks you've joined us. Well, it's, we have not been past the 17,950 odd. But what would negate this cautious view for you? If we break what level on the upside? So that's the first part. And the second part is, what's your view on the IT index? The NASDAQ went through a bit of a lull. The IT index as well did cool off a little bit. But today it seems to be coming back in style. Your view on both these two?
Yeah, Nifty IT is one of the indices I've been bullish on, but I've not been. Markets haven't given me a clear signal if that has to be taken forward as a medium-term bullish sign, or if I've treated it as just a short-term bullish thesis, and I've been bullish on specific names like Persistent and HCL Tech. And Persistent has come near record highs now. The worrying part is the heavyweights like Infosys, Wipro, and TCS. They are not giving much of confidence. So quite obviously, the Nifty IT index is not going as much as it should. But as long as 29,500 is protected for the Nifty IT index, I think it's okay. When it comes to the negation point for Nifty, I don't expect the 18,201 level the markets clocked before the budget started, that level to get taken out. But that is not the invalidation level. But I'm saying that itself will offer a resistance. But what would make me uncomfortable on my bearish thesis? The markets were to get above 18,300 to 18,350. It's a rough figure there. If it crosses that, then I'm probably going wrong. But I don't think 18,200 itself will cross.
Jay, any thoughts on Reliance Industries? That's made a big up move today.
Yeah, it's on a it's sort of a middling move. It's extreme short-term bullish, but the medium term is not that encouraging. The stock should not have closed below 2,400. It's sustained below 2,400 for several days. But I would look at short-term play for something like a swing trader. So something close to revisit of 2,400, 2,550. I don't see it going much beyond that. But it may not do much. It could just go sideways and that itself will be negative contribution for the indices. If Reliance doesn't contribute, the market would lack firepower.
Jay, I just want to revisit your call on the US 10-year as well. I know you've been maintaining that negative view. You're looking at yields quite carefully. Given the whole context, it's been, really, pushing that, I think, 3.7, 3.74 kind of a handle. What are the levels here you're looking at?
Yeah, I think the bond markets have given a very important signal. The bond markets are seldom wrong. So, I think the march is on for the next leg up towards 530 bips. And, if you look at the bond ETFs, which tracks the bond prices, they have broken below a trend line, whether you look at TLT or IEF, which tracks the 20-year bond or the 7 to 10-year bond. They have broken below a trend line that started the move from September. So they are also signaling that, the next leg up for the bond yields are there. And from I've mentioned this before, from a 24 months perspective or slightly longer, I'm expecting the 10-year bond yields to touch about 700 bips. This is a bubble that burst. It's a 40-year bubble that's been burst. So, I put out a note sometime back in May or April last year that, the 40-year trend line has been broken. So, the
Jay,
got a lot to go.
Jay, I'm just trying to reiterate this and digest what you're saying. You're saying this is a 24-month view, but this is the US 10-year we're talking about. You're saying 7%?
That's right. That's right.
Okay. Prashant?
He's got company, actually. I was speaking with somebody, and it's becoming a little mainstream. Actually, I should not say mainstream. It is not mainstream. The view is not mainstream. But Jim Walker, I don't know if you guys remember.
Yes.
Ex-CLSA was the economist. So the IIFL investor conference is going on in Mumbai today. And he made a presentation this morning where he said that the Fed funds rate, according to him, should get up to 6% and maybe even more. So he said it to a room full of people who
were optimistic.
And this is today, early in the morning today. So I was talking to somebody who was at the conference, and he said that it was people were a little baffled, and I think there are also now people, mainstream investment banks, etc., who are starting to talk about what could rates get to 6%, more than 6%, and things like that. So Jay has got company there. Although Jay's view, of course, is based on charts, and we've actually put that chart, that 40 years, starting 1989, right, Jay, where when. It was a one-way decline, and it's broken out, and we are so let's see how high it goes. Jay, of course, is talking about market interest rates, and Jim Walker was talking about the Fed funds rate. Yeah.
I think I should take Nigel's advice. If things are going, bonds are going to 7%, I don't know what Armageddon is coming. I think I should go and celebrate Valentine's Day.
But Surabhi, the point is that rates will only go so high if growth is so strong, right?
Yeah.
If growth
that throws the recession argument out of the window completely.
So there is no as someone said, I think there's no hard landing, soft landing. Maybe there's no landing. You continue to do well, which is not a bad outcome at all. Jay, I don't know if we're going to add to it briefly if you want to. Go on.
Yeah. An interesting part, Prashant, is that the 40-year before 1980s, there was an uptrend for the bond yields. So it's again it's dividing quite in equal proportion. So for a 40-year bond rally, I don't think a 5-year decline is too much to expect.
All right. Jay, thank you very much. It's always interesting conversation. Appreciate you joining in with that perspective. Jay Bala of Catch the Chaos with that perspective. 17,927 is where we are at. So we are up 150, 160 odd points. There is a bit of plateauing which has happened post, actually since we started the show at 2:30. We'll take a break. We are back. We'll get you what's happening in dealing rooms with Nimesh, who picks up all the chatter for you. And of course, our BTST calls with technical experts coming up on the other side.
Welcome back. You're tuned in to Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, it's been a kind of a good day for the markets. After a while, we have a bit of a trend day that's playing out. But Nimesh joins us to tell us what's going on in terms of D-Street chatter. Well, Nimesh, pleasant surprise going into the event with some green. Let's see how this plays out, but what's the sense?
Good day for the markets, but again, it's very very narrow, so to speak. Only a few large names are helping the Nifty to go up 170 points. If you look at the contribution plate, Reliance, ITC put together 70 odd points. If you add IT names to that, then almost 110 points have been added by these three big chunks, which is helping the Nifty. The breadth is still very weak. That was the case yesterday as well. The only difference is like yesterday there was not large selling. Today seems to be a bit of a buying interest from the large institutions. That's the overall feedback. Even if you look at yesterday's trade, X of Coforge, the net selling was just 450 crores. And today there is a small market at close basket buying is what I understand in some Nifty names. So that may help the FI numbers in today's trade. I guess a sector which has seen a bit of a recovery is the financials, and within that, the PSU banks are well bid is the overall feedback as far as flows are concerned. So that's a bit of a support for the bank Nifty as well. Technically, we're above that crucial level of 17,800, so that should help the bulls. If that is defended, maybe you'll see a bit of a pullback rally to continue. And the good part is, as I said, it's backed by some large cap companies like ITC and Reliance. But broadly, while the flows are mixed and with a positive bias, the breadth is still weak, and that's a bit of a negative point in today's market.
Nimesh, the FIs start selling less and they're net short on the index. Any kind of good news can help us get past the 17,950 odd mark, but let's see whether or not it comes about. But let's focus on individual stocks. What are you picking up?
So in terms of individual names, the couple of stocks which are buzzing in trade today are UPL and Reliance, and both are buzzing on back of very strong buy flows at FI. So the delivery volumes are expected to be quite high, and today's move is largely backed by FI buying as well in both the stocks. So that's a first set. The second is LIC Housing Finance. Flat in trade today. The stock has actually underperformed, but even at these levels, there is constant selling pressure from larger FIs. So it looks like one of the leading long-only fund is an active seller and looking to exit LIC Housing even at these levels. And the last is City Union Bank. We saw a big cut in that stock yesterday. It was down 15%. A small recovery in today's trade, but I believe even in City Union Bank, there is aggressive selling from a leading FI. And though there is a recovery in trade today, but there is selling pressure from larger FIs in City Union Bank as well in today's trade.
Nimesh, thank you very much for that informative and interesting list. Let's talk a bit more about the markets. IT gains have moderated a bit. The Nifty IT index was up 1.5%. Now it's only up about 1%. So some trimming of gains from the top. But on the flip side, PSU banks are seeing buying interest. The Nifty PSU banking index is up 1%, led by strength in Bank of Baroda, PNB. So just pull up those intraday charts. Mitesh Thakkar is back with us. He's going to tell us what you can buy today or sell today for a reverse trade tomorrow. Mitesh.
I have a BTST kind of a call on UPL. I think that's breaking out with a good price and volume action, getting above the short-term averages. Keep the stop just below 755. Look for 770 as the target for tomorrow. And on the other side, I think Apollo Hospital is something which has turned negative with the day-to-day and could see a couple of declining days in the coming week. So that's the STBT with the stop at 42.95 for targets of 42.35.
Okay, got that, Mitesh. Thank you very much for the calls this afternoon. And with that, let's move to our next conversation. Shivani Sarkar-Kurian, Senior Executive VP and Head of Equity Research at Kotak Mahindra AMC is joining in. Shivani, good to have you on the show and nice to connect after a while. So, you tell us what's the call. Good afternoon. Tell us what the call is. The market's been giving plenty of opportunities. There's no runaway rally. I mean, today is a bit of a different green day. But how have you been approaching things since the start of the year?
So the start of the year has been volatile, and we have been approaching the market slightly cautiously. Now, what we have seen this year is that overall our markets relative to emerging markets have underperformed. And this is of course coming on the back of the sharp outperformance that we saw last year. And so today, when you look at relative valuations of our markets vis-a-vis emerging markets, some of that excess has corrected, but we are still above long-term averages. In terms of absolute valuations, our markets are now inching closer to long-term averages. However, what we believe is that, globally, while inflation has moderated in the recent months, it's likely that interest rates possibly stay at peak rates for a longer period of time until central banks are comfortable in terms of inflation dynamics. So with this sort of a backdrop, it is possible that markets either stay range-bound or at least volatile in the near term. And what we've also seen, and now we are in the midst of the earnings season, is that, while at a headline Nifty level, earnings have been in line with estimates, there is wide variation and dispersion at the stock and sector levels. And therefore, this year will be a year when you look at stocks and sectors where you have earnings visibility. And therefore, markets will be somewhat more difficult to navigate this year than what it was in the last year, where market movement was pretty much broad-based.
Okay, and where is it, Shabani, that you have earnings visibility? One sector which has done exceedingly well has been banks. But now increasingly the opinion is the NIMs will start contracting for the banking sector. If not in Q4 of FY23, then perhaps in Q1 FY24. So that alpha which the bank was generating for the market may start coming down. Where is it that you are most bullish now?
So we continue to be more positive in terms of domestic facing sectors. So banks, the overall financial services space is one of the segments where we remain positive on. Apart from banks, segments such as industrials, manufacturing, capital goods, and automobiles. These are a few segments on the domestic side where we believe that there is still some degree of earnings visibility. So if you look at even this quarter numbers, a lot of the numbers in terms of earnings has been driven specifically by BFSI and autos as segments. Answering your question in terms of banks, yes, it's true that the kind of margin expansion that we saw in banks over the last year because of interest rates moving up and also higher credit deposit ratios, that kind of margin expansion is unlikely to be repeated going into FY24. Though there is still some headroom for margins to expand for banks possibly over the next quarter. What we also believe is for the sector, the focus is now moving from credit growth to liabilities, and incrementally banks will focus on deposit growth. And therefore, in that sort of a scenario, those with a stronger liability franchise, higher CASA, higher retail deposits, as well as a better share in terms of floating rate loans will be able to protect margins. Now, one thing that we must note about banks is that while the sector has seen significant improvement in return ratios and fundamentals, valuations on the sector at a headline level are still fairly reasonable. And we believe that in this sort of an environment, BFSI continues to be well placed because you still do have visibility of earnings growth. And remember, one lever for margins overall in terms of profitability could be OPEX, where over the last, again, couple of years, banks have been spending a lot in terms of branch expansion as well as technology. And when margins start to come off a bit, you do have that lever along with lower credit costs to manage earnings.
Shivani, afternoon, Prashant here. One clear area where perhaps there is a fair bit of price damage, right? So when you're trying to buy stocks which are out of favor, consumer durables is one such space, right? You look at Whirlpool, Voltas, Havells, there is V-Guard, even smaller ones like Orient Electric. Across the board, I mean, there's a fair bit of price damage which has happened. No one wants to buy them. But these are, again, I mean, consumer stories, generate a lot of cash, low debt. What's your sense, Shivani? Is this a place and time, rather, more importantly, to get in, slowly build a position?
Yeah, you're right. So this entire space has seen a considerable amount of underperformance. Valuations are now coming to levels where valuations do reach a point where downside risks could be protected. However, remember, for the overall consumer durable space, one trend that we noticed, especially in this earnings season, has been that there has been some amount of slowdown where discretionary consumption is concerned. And we'll have to wait and see whether this is a slowdown that gets repeated over the next few quarters, or this is just a near-term fatigue that is setting in terms of discretionary consumption spend. The other factor, which has still not gone away for the sector in terms of headwind, is that there is significant competitive intensity, and therefore pricing has been under pressure, which is now reflecting in terms of profitability and margins for the sector, which has also impacted the kind of performance that you've seen where consumer durables is concerned. So we will still wait and watch. You're right that, overall, given the correction, valuations are reaching a point where downside risks seem to be lower. However, when you approach the overall consumer space, at the margin, what we have also noticed is, if you look at the story over the last maybe year and a half since COVID was awaiting, was that discretionary consumption did better while rural consumption was lagging. Incrementally, when you look at signs that we are picking up on the ground is that rural cash flows do seem to be improving at the margin. It's not a runaway improvement, some sort of improvement slowly and steadily picking up, which then bodes well for the FMCG and the consumer staples space. Now, this is a space where we have also started seeing margins starting to improve. Pricing has gone up, and that should reflect in margins, and also lower raw material costs impacting positively on the margin front. And valuations vis-a-vis long-term averages are also fairly reasonable. So at this point in time, incrementally, consumer staples seems to be an interesting space to look at, given that we are now seeing incremental signs of rural recovery, slow and steady recovery on the rural demand side.
Shabani, we'll leave it at that. Thank you very much for joining in. There may be a rural recovery for consumer staples, but we were having a chat with the management of V-Mart, where he indicated that in the lower income group, there is still a lot of pressure, which is why the company went ahead and introduced lower price products. And that changed the product mix, reducing the average selling price by nearly 5 to 6%. So according to him, things are improving, they're on the mend, but there is still substantial pressure that they've seen in the lower income group. Get into a break. We'll come back with more market talk.
Welcome back here with us on Closing Bell. Well, we have just a couple of minutes to go before the day wraps up. Before that happens, let's get you an interesting story that we're picking up. We're learning from sources that the Directorate General of GST Intelligence has sent notices to about 10 to 12 mutual funds. And this is on a possibility that GST officials feel that there's some effort to sort of lower the GST liability by some of these AMCs. Let's straight away go to Timsy to get the details. Timsy.
Well, as you rightly mentioned, what we are picking up from government sources is that the Directorate General of GST Intelligence has sent notices or letters of inquiry to about 10 to 12 mutual fund houses, seeking details of their past transactions, which they find suspicious because they feel that they have booked certain expenditures against which they have claimed wrongfully ITC to lower their GST liability. To be fair, what DGGI has alleged that this pertains to their claims in 2017-18 and in these 2 years. And to be fair, they say that DGGI has found discrepancies in accounting by AMCs for expenses capped at 2.25% of AUM. They allege that mutual funds wrongfully accounted for the scheme of cost as capital expenditure to claim these credits. And now they are seeking recovery of the so-called wrongfully ITC that was claimed by these mutual fund houses. Collectively, the liability that DGGI has leveled against all these 10 to 12 mutual fund houses is around between 125 to about 500 crore rupees. They're not giving a final figure right now because in a lot of times they feel that the liability could be questioned, can be taken to court. So thus giving an exact figure would be in discrepancy there. So yes, as of now, wrongful ITC claimed by mutual funds under DGGI's radar. Back to you.
All right, Tipsy, thank you very much for that. Appreciate it. You know, we're just racing to market closing, so let's just have prices up and see what the closing is like. So we're going to end at 17,919, which is 150 points higher. It's a strong close, but I think we could not build further on the gains that we already started with, started 230 with. So the last 1 hour, if anything, I mean, I think some of the gains have been given up, are not built on. Maybe that's the way to look at things. UPL is the big gainer, followed by ITC and Reliance Industries. These are the 3% plus gainers on the Nifty. Losers, of course, Apollo Hospitals, iSure, SBI Life, and a few more, but nothing large or significant on the downside, at least on the Nifty today. Broader markets, of course, is much more varied. Rima.
Well, Apollo Hospitals is the top Nifty loser, and that reports numbers today. And the stock has ended at the low point with a cut of 2.5% ahead of numbers. But a lot of the auto names also came in for selling pressure. So Eicher Motors, where there was no positive surprise, so the stock was down 2.5%. Hero Motor Corp, Bajaj Auto. So many of these two-wheelers were weak in trade, and Bharat Forge too where the street was disappointed by the losses in their overseas subsidiary and the muted top-line revenue growth, also ending down in trade. Nykaa was the other notable loser in the mid-cap space, and that had a cut of nearly 4.5%. But in the broader markets, fertilizer catches your attention, right?
It does. Those stocks are RCF, NFL. Those were the real green spots in the market. But you were talking about Nykaa. I just also want to point out PB Fintech, Reema. Remember the huge pop that some of these stocks got immediately after results? Today, PB Fintech was down about 5%. So a lot of profit taking on Nykaa, on Zomato. Paytm was also down about 2%. So these are stocks that were on the downside of the screen. Oil India continued its good form from yesterday, another 6% on this one. So broader markets at a headline level underperforming. But of course, beneath the surface, you have some winners as well. Well, with that, we'll wrap up this edition of Closing Bell. Thank you very much for watching, but don't go anywhere. Our Tuesday special Commodity Champions comes up next.